All right, well, I'll go ahead and get started. So based on current market, just talking to you guys a little bit, I think you guys are feeling it. Um, to state the obvious, the macro market has taken a dump in terms of capital deployment, as well as just valuations are plummeting. Everyone's kind of coming to the realization that everything's been overpriced for a long time. The Fed is jacking up rates. Capital, you can get a much safer, more reliable return into safer assets than riskier assets. So a lot of capital just leaving the markets as a whole, or just values have just dropped dramatically, causing LPs to not be as liquid as they were when it comes to investing in funds, bringing us to kind of the venture market, which has been the worst I've seen it since 2009. I was saying about 2 months ago, it wasn't that bad. It was around 2019, kind of like experience, but now I'm kind of going, this is looking like 2009 situation, pretty quickly. And FTX, if you guys aren't familiar, the crypto exchange that exploded or imploded this past few weeks, has just sent ripple effects into the market that has everyone rethinking how they're deploying capital in venture, and leading to a lot of governance and oversight type questions, which one is putting VCs on their heels. So VCs have been notorious for the last 2 years of just getting allocation at any cost. Get into the hottest deal, get it marked up, go out and raise another fund as quickly as possible. Typically, VCs go back to raise a fund every 2 to 3 years. In the last 2 years, they were going back every 12 months and trying to capitalize on all this, hype. Well, now their portfolios are getting corrected, and some have been hesitant or in terms of being honest with those certain valuations, and it's misleading to a lot of LPs. So there's just a lot of misinformation, concern, hesitation on just the LP GP relationship. And just as much as it sucks for you as a founder to raise capital, sucks just as much for a GP to go out and raise capital. All their metrics are taking hits. It's very difficult to raise capital, and LPs have basically come out and said, we're consolidating our capital into the bigger, safer, more well-run funds. So a lot of the micro VCs, smaller VCs that have been kind of helping democratize access to venture, a lot more opportunities, are going to be really hurting in this particular market. So for a lot of like pre-seed, seed stage companies that don't fit the bill for a tier 1 VC, could have an extra uphill battle. Also, there's still capital. Everyone's talking about the dry powder in the market. In capital in the market. Oh, got some more people coming in. I'll go ahead and get them in here. Did they get rejected, Allie? Just had a couple people join. So that all said, basically with the current market conditions, that dry powder, it's been jokingly called wet powder, mainly because that capital is being allocated to existing portcos. It's estimated that about 70 to 80% of the deals done recently and expected to close soon in this quarter are all follow-on capital to existing portcos. Founders were told a year ago, burn and scale at all costs, and don't worry, we got money. We'll help fill the gap when you need it. Just focus on growth. And now, without any warning, those founders are now being said, "Oh, you're capital inefficient. You need to be, cutting your burn. You need to focus on profitability. What were you thinking?" And you're just like, "You told me to do it this way." And so, a lot of founders that raised capital in the last 2 years kind of went heads down, grow at all costs. Now they're coming up for air, going up for the next round, and slapped in the face with this new reality. And so basically, as far as some of the key things to kind of keep in mind in this current state and what's going on, as far as, I imagine most of you here are pre-seed, seed, maybe Series A companies. Some things to kind of expect is what was happening a year or two ago. You may have been able to raise at, like, say, $10 or $15 million pre-money for your pre-seed. you could potentially expect a lower valuation for a seed round despite your traction. It's unfortunate and difficult to understand in some cases and looks bad, but at the end of the day, if you need capital, you need capital. So I'm advising everyone to kind of expect lower valuations, if not down rounds, from what they had previously expected. I'm seeing companies that are doing $9 million a year in revenue, have a relatively reasonable burn and high growth rate, and are having to come down to like 25 million, $35 million valuations to get capital in the door quickly, because they were on the grow at all cost, and now there's no capital for them with that model anymore, and so they're having to make drastic cuts, and they're trying to lower their valuations as much as possible. I'm seeing seed deals with $1 million ARR that are doing 7 million in valuations, whereas previously that would be like a Series A 20 million plus, just 4 months ago. So this is some of the experience that I'm having with all of our clients and companies in the network, and what we're seeing valuations come in at. And we're doing a lot of advising on these companies because, again, they're coming in from the expectation from a few months ago and thinking that everything's fine, and they're coming into expectations now, and it's just not the case. VCs will pretty much write you off if you're coming in raising an excessively large round without the numbers and traction to back it up. The kind of like vibe investing, which was coined last year, where it's like VC's like, I got a vibe that this will work out, no due diligence, write a check within a week, all in, and then those deals are just not happening anymore. You can expect to spend about 3 to 6 months raising capital once you start opening up your round. We'll talk about advice and like how to structure yourself towards the end. So if you have any questions around that, we can talk about that. Expect proper due diligence. And what that means is what we've seen, like I said, in this last example, almost no due diligence, no governance, no boards like Liquid SPF did at FTX, no board, no governance. And yeah, this is the kind of stuff that happens. $32 billion disappears overnight. And that's just not going to be acceptable anymore. Banking off a big name is not going to happen, not support and close out a round. Say you got Greycroft or AC16 or Colsa or any kind of like big name coming into your round. That does not necessarily mean you're going to close out the round. Whereas historically last year, if you just list a big name, everyone just said, oh, if the big name did the due diligence, it must be safe, take my money. And that's out the window. You have to be a well-structured, properly documented, proper data room, proper due diligence, and that takes time. And so you need to budget your burn rate accordingly. And I'll be happy to share a guide if you guys are interested. We have a guide that we share with all of our white glove clients on how to structure your data room. So happy to kind of pass that around to just start preparing yourself, because if you start your raise with an already structured data room, streamlines everything, gets VCs in and out pretty quickly. They'll either determine that they're going to continue interest because they saw the data room, and you'll get that signal earlier rather than later. If they have to request the data room, it could take a lot longer for you to prepare, get it ready. So it's best to get started with your raise with the data room already prepared. So I want to talk about some positives about this market. It could have been a little doom and gloom, but there is some good stuff about this. There is dry powder out there. It's just more closely guarded than it historically has been. It's available, it's accessible. It just takes a lot harder. It's a higher hurdle to overcome than it has been historically. So if you are setting up your business for success and you really focus on building sound fundamentals, sound unit economics, and you truly are venture scale, you're still going to be an attractive opportunity for a lot of VCs. It's just being deployed a lot slower. So just fewer deals will be getting done. We saw funds depleting their entire fund within a year, when historically it's been 3 to 4 years. And so we're going back to that 3 to 4 year deployment cycle. So when VCs say they're going to have a portfolio of 30 companies, they were making 30 investments in a year. Now it's going to be more like 10. So you're just going to see a lot more scrutiny, a lot more time taken into the deal. But when you get that VC, you're going to get a lot more attention. You're going to have the opportunity to truly build a relationship with them and receive their help and assistance, which is where, as far as, I'll get to advice later, but really focusing on relationship building right now is where the highest ROI can be in terms of your fundraise. Ideally, before you even kick off your fundraise, talking to VCs and building that relationship early on, spending more time listening and learning, as opposed to pitching all the time. And then from there, one huge thing, and this is what VCs are going to expect to see from you, is talent acquisition. The talent market is getting extremely good looking for startups right now. Top firms, like Facebook, Google, all these people are having huge layoffs, Twitter, obviously. So top tier engineering talent, sales talent, all these recruiters. How are you going to get that talent in your company? What's your story to recruit and retain top talent? And that's something a lot of founders just don't spend a lot of time thinking about, especially in the pre-seed, seed, and Series A stage. But it's one of the most important attributes that VCs look at. They never really say like, "Oh, how are you gonna recruit the best?" But they look at you as a founder and say like, "Would I want to work for you?" And that's a story that I think founders should start articulating into either their pitch, their deck, or their materials, because this market is where some of the biggest companies will come out of. So the last recession in 2009, the Airbnbs, the Ubers, and all these other big companies came out because there was a large talent pool of amazing talent that was untapped because the big companies had made big layoffs and they weren't as attractive. And this is the time to get in early at high growth opportunities. So talk about how you can get access to that talent, recruit that talent, and retain them. Another good thing is your competition is going to start to disappear. As the capital dries up for you, it's drying up for your competitors, and whoever has the strongest business will survive. Eliminating that competition, forcing customers to go to the alternative solutions out there, which hopefully would be you. And so that's going to be something that is an opportunity to capitalize on. We're going to see a lot of consolidation in the market, a lot of businesses that had good ideas that were poorly executed are going to get eliminated, and that noise will be eliminated from the market. Advertising will get cheaper. Customer acquisition will potentially get cheaper. So this is a huge opportunity with the market forces that we're in. And like I mentioned before, like some of the best unicorns came out of last recession. And so for VCs that are actively deploying into new deals, they could potentially be getting into some of the best deals that we've ever seen, similar to what happened 10 years ago, 12 years ago. So let's talk about holidays. I'm wearing my holiday shirt. If it's not obvious to you already, from next week to the first week of January is pretty much the worst time to raise capital. A lot of that has to do with the fact that VCs just take off. They're focused on events. They're focused on engaging their LPs, providing annual reports to their LPs, catching up with all their existing portcos, going to holiday parties. It's rare that net new deals get done between this period. It's not to say you can't get a meeting, not to say you can't make progress, but it's basically like a 6 to 8 week dead period that becomes extremely difficult to raise capital. Now, this is historical. I have raised a $11 million Series A for the last company that I was at and got the term sheet on New Year's Day. So we were working through the holiday break with the VC called Altos to close the Series A. It is possible. It is very much a possibility, but that was a term sheet, not necessarily check in hand. So relationships started pretty much the week after Thanksgiving, and we got a term sheet by January 1st. Granted, it was a Korean firm, so Christmas wasn't as a high priority, and holidays and whatnot. So they were willing to work through the holidays, and it wasn't an issue for them. But I do want to make it clear, it is possible to raise during this time. It's not impossible, but it is extremely difficult, and the risk that you run is going stale. And that's what a lot of founders don't realize is if you shop your deals starting now or going into the holidays, and you've made no progress over like an 8-week period, have nothing to do with you. Just you basically pitched the wrong VCs at the wrong time, or things went too slow. And when you come back to them, when they're all like now checking their emails and looking to do deals, they're going to look and like, oh, you haven't made any progress in 8 weeks. Like, so what's, like you're not doing well. Like, I don't know that, and then they see a negative signal. So there's a fine balance of, how you handle going to market. And we can, this is if you guys have questions about if you're in the market right now, currently raising, what are some of your choices? As well as if you're thinking about going to market, what are your choices? And then the inevitable is, well, you don't have a choice because you're running out of money and you got to raise money now. And what's the best way you can succeed? So at this point, if you have questions on either the state of the market, positives or negatives, let me know. Otherwise, I'll start going into, kind of what's my advice in one of those 3 circumstances. You've already started your raise, you are thinking about raising, or you don't have a damn choice, you're running out of money, and you need to raise capital soon. So a couple things to kind of keep note on all. This is applicable to everyone, despite the timing. Okay, good question. Is this true for angels as well as VC? So angels much more likely to invest in this time period than a VC because they don't have any oversight. They can do whatever they want. Now, the problem you run into is a lot of angel capital is dried up. It's not impossible, but they're taking a huge hit. As far as my personal experience as an angel and investing into deals, it's pretty much dried up because a lot of my capital is tied up in public markets. I take that money, put it into private, and obviously market's taking the dump that they have. There's just less capital to be deployed, so I'll be doing fewer deals or smaller checks, and that's just kind of how. Again, not impossible, but the market has shrinked for angel capital. So it's not far off. An angel can write a check whenever they want. If you get in front of them, there's a chance. And we're going to be doing a stonks event. If you guys aren't familiar with stonks, we're going to be doing a stonks demo day for a select group of companies in our network, between 6 and 10 most likely, which will be targeting mostly angels because we're trying to get a couple of those clients basically some capital in this dead period, because that's about, that angel capital is pretty much the most accessible at this time in this period. There's another question in terms of VC and angel versus as far as trending. I don't actually have like a report right now, just on comparing angel investment due to VC, but hopefully that's help clears it up. So I want to kind of go through some general advice on what to expect from the macro. Yes. What was that, George? No. If you guys have questions, make sure to just type them in and have you guys mute yourself in between. So I'll go on through some macro, and then I'll go into the timing that we're dealing with right now, given the state of the holidays. So from a macro perspective, the closing a deal in less than a month is just unrealistic at this point. VCs have no incentive to do so because they know deals aren't getting done and they know they have time. So if you try to pressure them saying, we're closing our note next week, are you in or are you out? All right, we're out. So the pressure tactics don't work anymore. We've tried it a few times. It's gone. It rubs people the wrong way now. It was the thing to do before. Now it's not. Now it's about considering the relationship, picking the right VCs to build that relationship with, on how they can add value to you and how they can help grow your business. And that's going to be typically over a 3 to 6 month period. The recommendation in this current market and this timeline right now would be to focus on reaching out to VCs from, hey, I saw what you did for XYZ company. We're doing something similar from this perspective. Here's a little bit about us. would love to get your take on this market and what we could do to scale our business and potentially be worthy of your check down the road. Something along those lines to open yourself up for feedback, open up to listening and allowing the VC to, kind of share their advice. VCs love to talk. They love to feel like they're adding value to their portfolio. And the best time spent over the next 6 to 8 weeks could be just building those relationships. If you don't need the capital right now, it's better to not actually officially open up your round and to more or less focus on the relationship, because if the relationship's going to go anywhere, I will conclude into the round at some point. So making sure you have an extended runway is going to be crucial there. I kind of mentioned this already, but the no diligence periods are gone. Everyone's going to be doing diligence. They're going to do background checks on you. They're going to do code reviews. They're going to do legal reviews. They're going to verify your metrics. They're going to want to see your dashboards. They're going to want to see your Stripe accounts. They're going to want to see and validate and verify your claims. If you have any misleading claims, if you say you have ARR, that's annual or recurring revenue, but you're actually just transactional and you're calling it ARR, you just burnt a bridge. That's something that you got to be very careful with the terms and KPIs that you are referencing and making sure you're accurately calculating it. If you claim you have like this massive LTV to CAC ratio, so lifetime value to cost acquire customer, and you claim it's like 15x or something like that, but you're not taking into consideration the true cost of acquiring a customer, and you're just saying marketing spend, or you're not including all your marketing spend, you're not including your staff, you're not including the full story behind that CAC, you burned a bridge. Because then they're going to be like, what else are you hiding from me? And they're more incentive in this market right now to say no to you, because as a newsletter I follow just kind of came out with this term, JOMO as opposed to FOMO, the joy of missing out as opposed to the fear of missing out. It was all about FOMO last year, and now it's all about JOMO this year. Especially when it came to FTX, everyone's celebrating the fact that they had that deal in front of them and they said no, or they didn't get the chance to get it. Board governance and just company governance as a whole is going to be something that you probably should ask for, as opposed to wait for it to be presented. If you don't have a board, or you feel that you don't want or need a board, those can send negative signals. Pretty much any lead VC at this point right now should be asking for board seats, not just board observer, but like board seats. Because of this whole governance issue, these companies blowing up, more and more are going to happen. So VCs are going to try to protect their interest and have a position on the board to have an influence and also have insight before these things could potentially happen to help save them. Imagine if FTX had a board, probably couldn't have got away with the stuff that they got away with over the last 6 months that led them down this spiraling path to debt. So be prepared for, if you do get a term sheet, or if you're talking to VCs and building that relationship, openly talking about how you could use a board and how you could use the overall governance to help improve the company and put you in a healthy, stable growth position. A lot of founders last year, and still some might be without, don't want anything to do with the board, and they're missing the opportunity. Having a board holds you accountable, keeps you on track, and sometimes it can be a little extra work and distraction, but quarterly board meetings are, in my opinion, totally worth it and should be something that most founders in early stage should pursue, especially after seed stage. It used to be more Series A, but I would even say seed stage could be helpful, like a 3-person board. Don't let valuation be a sticking point. It's over. The high valuations without justification. The 20% dilution is still potentially a thing, but you could potentially expect maybe 30% on a round, maybe a little bit more, especially if you didn't hit all your metrics going into this round. So just mentally prepare yourself to not necessarily come to the table with an expectation on valuation outside of maybe just, it'd be nice to only get diluted by 20%, but that also does the amount of money you're raising match up to what your valuation could be. So if you follow along, if you're raising $1 million, let's call it a seed round, then you're probably expecting a valuation around 5 to 7, somewhere in that range. So if you want a higher valuation, you want to $15 million valuation, you want to raise $3 million bucks. Okay, that's fine, but does your company really line up in this market to a $15 million valuation? And I would say you'd have to have some pretty extreme growth and traction to even warrant a $15 million valuation these days. So just kind of keep that in the back of your head when you go to market. And again, it's about going to market to build relationships with VCs at this stage, and allow them to kind of coach and advise you on where your valuation might fall, which is also something that we do for some of our white glove clients. Another way to kind of avoid valuation talk is doing safes and just having a cap. Those are very popular right now. A lot of bridge rounds happening. A lot of shark deals type thing where great company, everything's great, but they kind of did the burn at all cost, grow at all costs. Now they have to do this bridge financing, which doesn't look good. And they're taking effectively a note, which they're kind of declaring as not a down round, but they might be have a lower valuation or a flat round. And that's another tool in your toolbox to support you. Also, founders are doing their most to avoid down rounds or flat rounds, and they're instead having a markup, but they're doing liquidation preferences. If you're not familiar with liquidation preferences, it basically means if I'm investing $1 million in you with a 1x liq pref, what that means is I get my $1 million back before anyone else does. So my return is preferred over everyone else. And 1x is kind of not unusual, but I'm starting to see 1.5 and 2x. So if I put in $1 million at whatever, a $10 million valuation, but you sell for 5 for whatever reason, I'm getting my $2 million before anyone else gets paid. So liq pref is extremely dilutive at the end of the day, and it's some kind could be more mathematically advantageous to the founder to take a down round than to deal with liq pref. So there's some other things and variables to kind of take into consideration. If you get some term sheets coming out and you want to run them by anyone, feel free to hit me up in the Slack group or ask questions if you want to kind of get some feedback on that, because those are difficult and sensitive issues to navigate. Always happy to help on that front. So kind of getting into how to best position yourself. Another alternative is alternative financing. So revenue-based financing, term loans, debt. Debt's expensive now, but it's can be a lot more accessible for revenue-generating businesses. So that's something to take into consideration in this market to kind of either avoid a down round or avoid the lengthy process of investment committees and so on. Whereas some of these revenue-based financing platforms or other debt financing solutions tend to move a lot faster and are more mathematical and not so much judgmental on what goes into their thesis and so on. So if you have revenue, it could be an option for you. Also, start meeting in person. That's another expectation that VCs have. They want to go back to in-person meetings. We're going to probably start seeing a little less geographic dispersion than we have over the last 2 years. It's still a possibility. It's still normal case of business to never meet the founder and never meet the VC. But now with all this time, founders, we're helping founders set up basically roadshows. Go out there and fly out to San Francisco, New York, Austin, Miami, and focus on building those relationships in person. Whether going to an event and leveraging that as the main reason you're in town, but using that to meet with investors, that's an incredibly good use of time. If you feel you're truly venture scale, you have a good fundraising story, getting in front of VCs in person will be a game changer. One, it's a differentiator because a lot of it's still not normal again yet, but it's going to be, and a lot of VCs are going to prefer it and they're going to prioritize it. So that's a really important tip, especially in that, again, another timing thing in the holidays. Things are a little bit slower pace. Going out for a lunch meeting, a breakfast, a drink are all great ways to build those relationships with those VCs. Trying to think if I missed anything on my. So when it comes to preparing yourself for the fundraise, this is generic anytime advice, but I like to say it because there's a lot of companies that go out and raise because they need money, but they're not fundable. And you end up spinning your wheels trying to raise capital when it will most likely not end well, or you won't raise enough to succeed effectively. And so this, what it comes down to is how can you best extend your runway. So reduce your burn and extend your runway, because you're going to need more time to get the traction you need. If you're not growing at least 10%, 20% month over month and driving actual sales growth, or if you're more of like a deep tech, if you don't have like acceleration progress in the development and validation of your MVP or your product, whatever you're working towards, you don't have like basically velocity or momentum in whether it's sales, user engagement, product development. If there's no significant momentum, you will have an extremely difficult time getting attention in this market, because there are companies that have traction, and those are the ones that the VCs that are deploying are going to focus on. So that's your competition. And you have your own competition in your market, but then you have competition when it comes to capital raising. And when you go up for investment committee, for you guys aren't aware, when a VC makes a decision, how it works is they meet with you, maybe they, do some due diligence. They meet with you meet with a couple other people on the team. They eventually get you to what's known as IC, investment committee, and then you're put up against 5, 10, 20 other companies that everyone's pitching around the room, and you have to be the best company of that pool. And if you're not the best company in that pool, you're not going to make it. And another thing that I try to help founders on is a lot of founders get their hopes up. They're like, oh, we're in due diligence. It's going great. I'm so excited. But when that VC kind of keeps pushing you back, kind of saying like, oh, you're going to be an IC next week, or next week, it'll be next week. Oh, hey, it wasn't a hit in this IC, but I'll bring you back next month and we'll see how it goes. That's pretty much a dead deal. And you should pretty much plan for that deal to fall apart. If there's not an acceleration or momentum of continuous involvement and engagement with a VC, they're just not that into you, or they have a better deal on the table that they have to prioritize. So don't put your eggs in all that basket. Don't wait for them to be your savior. Go out and make another deal happen. I see this happen too many times where founders get excited because like what happens is you have like an associate or a principal, maybe even a partner, that's like, leading the charge on your case, but they're not the top dog in the org. But they want to keep you on the hook because they really like you. But as far as the rest of the team's concerned, it's dead. And you got to be aware of those dynamics in the venture capital world, because they're more prominent than ever right now, because just so fewer deals are going to get done. You really have to stand out. And traction, momentum, sales growth, reasonable valuation, being coachable, board governance are all attributes that VCs are looking for now and are going to be expected to focus on. So, and also focus, when it comes to your product, and I'm seeing this happen all the time right now. A lot of deals were getting closed last year for a wide range of products and ideas. But what's going to win right now, what VCs are going to focus on right now, it's all about what's hot for VCs. Like what's going to be the sexy thing. Like with COVID, all the stay-at-home stuff exploded. When crypto was doing well, it was all the crypto Web3 stuff. Now that's dead. The work from home stuff, there's some, still some stuff happening there. But the next big thing is what's recession proof? What are true painkillers for companies that are going to save them money in this time? A lot of VCs will be shifting towards software and solutions or services that save cost. Healthcare is going to be very popular, and other markets that tend to do well in recessions are going to be where VCs, look to for potential deals that would be hot in this particular market. So when you look at your product roadmap, what you're building, are you building a painkiller for your target customer base in this market? I just stuck with a really interesting company. I really like the founder. He's got an incredible track record, sold a 9-figure company. But he's selling a nice to have in a market that is not spending money on anything right now. And they're going to have an incredibly difficult time both closing deals, which means they're going to have an incredibly difficult time raising capital. So when you look at and reflect on your business and what you're trying to do, that's something that you really want to analyze. And if you have the runway to potentially afford a pivot to drive the product more into a painkiller offering, it might be worth your time to kind of go heads down and work towards that, to which also you can fundraise on that type of pivot. So in a situation where you have an existing business, you recognize the fact that you might need to make a shift, but that shift opens up a lot of opportunity in a sexy hot market, you can raise on an idea in that sense. You can raise on the fact that you have a team, that you got some validation in terms of you've proven something, and now you're adding on or transitioning to this opportunity to open up more doors. VCs tend to have an open mind and into that front, assuming that the team's great, the idea is great, the market makes sense, and it's a hot opportunity. So that's how you can kind of dodge the traction discussion and the lack of traction, is finding a really hot market to apply a solution to. I guess the most famous example would be like Slack. If you aren't familiar, Slack was a game development company before it invented the messaging app that we all know that's over 26 billion. And that was like the whole thing. They spent years, raised a bunch of money from A16Z. I think it was like 30 million or whatever to go build a gaming platform or a game, and it bombed horrifically. And with the remaining capital they had, they fired everyone and pivoted to Slack and became what it is today. So there are opportunities. You just have to be smart in terms of how much runway you manage, how capital efficient you are, and how open-minded you are to the dynamics that is no longer a founder market, it is an investor market when it comes to deal terms. So I kind of dumped a lot on you. So I'm curious if there are any particular questions or scenarios that you would like me to address specifically, or ideas that you want me to address. You can type it out at this point, or you can discuss it if you'd like.
So I have a quick question that's fairly specific. So I've been kind of like going down the road of raising the equity around for the sole purpose of unlocking debt capital that's asset backed. Because in the space that I'm in, electric vehicles, traditionally asset backed like assets. And so that's available, but proving the underlying fundamentals is kind of like the critical piece. So I was always trying to raise enough equity so that I could unlock enough cars to prove things that would unlock future scale. And that's still kind of the goal, but it seems as if raising early revenue round at like a $3 million raise is going to be incredibly dilutive at this particular moment. So, I mean, obviously, without knowing the specifics of exactly where I'm at, would your recommendation be to kind of scale back that ask, raise enough to just keep moving forward, as opposed to kind of like stagnating at where we currently are, which is like early revenue and self-financing these individualized vehicles one after another?
So in that particular situation, there's a game you can play. There is go to market quickly with a $3 million raise. If you have you gone to market yet?
No, I've had some preliminary conversations, but not really, no.
Okay. So there's one thing you have to avoid in fundraising in this market, and this has been any time period. You don't want to become stale. You don't want to be that deal that someone sees 4 times.
Yeah.
And and so what it comes down to is within a close circle, like who you can get warm introductions to. And this is like going to relationship building. You don't necessarily say, hey, I'm raising 3 million.
Yeah.
You're saying, hey, we got something interesting. Particularly whoever you're reaching out to. This is not a mass cold email situation. This is an individual outreach. For whatever reason you're reaching out to that person, list that reason, and ask for their input on, given what we're trying to accomplish and the scale of what we're accomplishing, we want to have a discussion and kind of see if this is one, something you're interested in, two, what you think might work. Because I can tell you, yeah, go out for how far can you get with a $500,000 note? What kind of traction can you produce? $1 million. Like what? Because it all comes down to when you're raising pre-seed, seed, and Series A. Those investors care the most about what milestones does that money get you to raise the next round. And if I give you $500,000, but you can't do anything with it, you can't really make a dent, and then you're going to be back in the market in like 3-6 months. It's not a great outcome.
Yeah.
And what's great about the strategy I just mentioned in terms of that relationship building of getting in the door with a couple of VCs, having that conversation, and now they're a part of the decision. And now they'll have more kind of commitment to the overall idea and what they're recommending. And they're going to recommend something that they would be comfortable investing in. And so that's going to be a good outcome.
Yeah.
I think we have to start taking a step back as founders, because over the last couple of years, we've been taught, throw out a value, throw out a cap on a note and, go ham, and just like, you'll get money. Whereas now everyone's really sensitive about price. I have founders that came to me from still shopping a note that was priced a year ago. It's like that, you can't shop that note anymore. You cut that in half and maybe you can talk. So that would be my advice, because I don't have all the specifics on what your revenue and all that kind of stuff is, but
yeah,
you could find a situation where you can raise 3 on a 6 pre.
Yeah.
Giving up 33%, but that gives you what you need to go out and have a much less dilutive round down the road. And dilution is just going to be a fact. Like, what a lot of people don't realize is, like, if you truly hit a home run and you're the unicorn, most of these founders are walking away with less than double, most likely single digit, low double digit numbers.
Yeah.
And that's a lot of having to do with the unicorns that we've seen recently, or over the last couple of years. They were raising these types of rounds 6-7 years ago, 8 years ago. And where you get it back, and this is how you win, you hit those milestones and you ask for an option pool grant. And like that's how you basically get through this hump with taking that dilution hit now. But you start the conversation saying, well, I'm going to take, I want the 3 million, I'll take the dilution, but what I want in return is the consideration of, if I crush these milestones, I want an option grant.
Yeah.
For you, your team, however you want to do it.
The Elon Musk strategy.
Yeah. Yeah. Despite some of the haters on Elon, he's got probably, he's got a fully governed, full board, full governance, even though everyone looks like he's running the show 110%, to which, acts like it, but it's because he's delivering results and he's continued to deliver. He's the only person that's built more than, $300 billion companies. So people want their money on. Any other questions I can answer?
That was helpful. Thank you.
You guys have me. You got me for another 8-10 minutes. If you guys want to ask a very specific question to your scenario, I'm all ears. Yeah, it's very common. It's very common actually in private as well. That's something that happened to me in my previous exits. Basically giving option grants prior to, exits or, M&A activity and funds. But also see it as an opportunity to retain talent, because if you offer whatever your top engineer 5% equity or 2%, whatever it is, and now they're taking a 33% hit on that, you want to educate them on why that, taking this money in will make them worth something, as opposed to if you don't take that money in, it's worth nothing. It's always a common conversation to have, but then also that you're going to fight for them, assuming that they're worth fighting for, to get an option grant down the road on the next financing. And you're going to see a lot more creative terms coming out, this next year or two from VCs, where they try to incentivize hitting certain milestones and so on. So I'm keeping it wide open. Anyone can ask a very specific question about their current fundraise situation. this great opportunity if you want to dive in. Gonna give you very specific feedback. Otherwise, we'll wrap up early. Going once, going twice. All right.
So this is not specific to anything. It's more general on the focus that you kind of mentioned of like networking. Are there specific like events around the holidays that you would recommend in kind of these pockets around the country, SF, New York, Miami, Austin, that we should be getting on lists for, like trying to network our way into, that you think would be valuable?
You're not going to like this answer, but the events that you're not invited to are the best events to be at.
Yeah.
And so how you get invited to the good events is you start showing up to the public events.
Got it.
You know, there's usually like the big networking events, 90% of it's irrelevant or not good for you. Yep. But occasionally there's those couple sparks that happen at those events that open up other doors. So, you know, assuming it doesn't distract your ability to execute, as a founder, you should always be going to any and all, at the very least, local events. Mm-hmm. You know, like Summit just happened, you know, Web Summit and a couple other events. Like there's some like the bigger conferences that happen, mm-hmm. Where a lot of like, you know, movers and shakers can be. You know, those can tend to be worth it. But generally local events are a great way to kind of get your foot in the door. There's always every city has like local startup events. Yeah. And what it matters is meeting as many people in those rooms as possible to then find out that one or two person, you know, people that turn into something valuable, and those get you into the doors that matter down the road.
Network locally to unlock the network that's valuable down the road. Network exactly. To network.
Yeah.
Yep. Makes sense.
Unfortunately.
Specifically,
just give me the good people now. Why don't they show up at my door?
If only that's how it worked.
Yeah, no, and it sucks because as a founder, you're told grind it out. You know, nothing else matters. Prove your model. You know, raise money, all this stuff. But like, you kind of have to have this other life where you're going out networking and building relationships before you need the money, because it's the relationships you make before you need money that lead to money. And when you come out and you have 3 months of runway and trying to raise capital and you didn't crush your metrics, it's going to be extremely difficult.
Yeah, your back's against the wall at that point.
Specifically, the in-person events are going to be the ones that are going to be the best for networking. And then I would make sure you have a method of following up at those events, that you're not like jotting stuff down on your phone. Make sure you've got like a very systemized, easy way of getting everyone's info and then being able to follow up.
Got it. Good advice.
Probably a good time to just chime in and introduce Toby. He's part of our Thunder team. He's an associate with me.
I'm the one that's probably looked at all the decks here.
High probability.
Yeah.
All right. Well, if we don't have any other questions, I'll give it another, awkward pause and see if anyone wants to ask a question. Otherwise, we'll go ahead and wrap up.
There's one here, a question for hot markets in 2023.
Oh, yeah. So my prediction, healthcare, I think will continue to do well. I think life sciences, biosciences, synthetic biology, alternative energy will be kind of like more the hard asset type categories. I think will do very well over the next year or two. SaaS that retains customers and has a very low churn, I think will win out in this market in terms of capital raises. Obviously, it's kind of a common sense, but there's been a lot of poor performing SaaS companies that got deals done, but that it's going to be harder in this market. I have another prediction. I just totally blanked on it.
VCs are looking for a breath of fresh air.
They are looking for, I think fintech still has a lot of potential. It's just not going to be as hyped as it was. I'm seeing still a lot of fintech deals get done. But the thing is, the real kicker is like, are you building something that people need or something that people want? And the things that people want just won't cut mustard right now. Battery tech with a focus on EV usage, is that a space that is saturated or could use more place? Well, personally, I think anything that improves battery efficiency will be hot and relevant. If you truly have an innovative battery tech solution, you're going to raise money. It's such a massive market that has no idea how big it really is in terms of scale. Like when you think about all cars being electric, like it's just an absurd number of volume and batteries that's never existed on this planet before. So anything that can reduce size, efficiency, performance that the big guys don't already have, then yeah, I think that's gonna be a no-brainer. It's just, I have a good friend who's a PhD in specifically battery technology, and like he's been working on a thesis for 1% efficiency improvements. He's gotten like $1 million grants. So yeah, I would bet on battery tech. I'm invested in public ETFs that focus on lithium and battery technology. I think it's still a bullish case despite current valuations of the car manufacturers and whatnot. But I think there's a lot of opportunity there. So I know we're over time. We got 3 o'clock, but appreciate everyone coming out. Allie, if you could, let's message everyone that I mentioned our guideline for building a data room. We'll get that shared via email to everyone that RSVP'd. In addition, we'll get this, I think we have this recording and we'll be able to post this up for anyone that wants to check it out after the fact. But appreciate y'all coming by. And like I said, if you have any personal questions or specific questions, you can Slack me in the group.
Thanks.
All right. Thanks.
Have a good afternoon,
Bye.
everyone.
Thank you for coming.
Cheers.